Governments like to present themselves as the ultimate decision makers. Elections are framed as moments when history turns, when voters choose a direction and the future bends accordingly. Budgets are announced with theatrical speeches. Laws are passed after months of debate. From the outside, it looks like power flows from voters to politicians and from politicians to policy. But underneath that surface is a quieter system that never campaigns, never gives speeches, and never needs permission. That system is the bond market. Every modern government survives on borrowing. Taxes rarely cover spending, and when they do, it is usually temporary. Wars, welfare states, aging populations, recessions, and political promises all require upfront money. That money does not appear by decree. It comes from issuing bonds E is sold to investors who expect to be repaid with interest. The moment a government enters the bond market, it accepts a constraint more powerful than constitutions or courts. It must convince strangers with capital that lending to it is safe. This is where the illusion of political power begins to crack. A parliament can vote to spend more. A president can promise stimulus, tax cuts, or universal benefits. None of those decisions matter if the government cannot borrow at an interest rate it can afford. The bond market is where those decisions are judged, not every 4 years, but every trading day. Politicians face voters periodically. Governments face bond investors continuously. At its core, the bond market is brutally simple. Price and yield move in opposite directions. When investors trust a government, they buy its bonds, prices rise, and yields fall. Borrowing becomes cheap. When trust erodes, investors sell, prices fall, yields rise, and borrowing becomes expensive or impossible. There is no negotiation. There is no appeal. The market does not care about intentions, ideology, or excuses. It only cares about one question: will this government repay me in real terms? That question is more complex than it sounds. Repayment is not just about avoiding default. Inflation is a form of default. Currency devaluation is a form of default. Financial repression, forcing domestic institutions to hold government debt at negative real yields, is a form of default. Bond investors price all of this in. When deficits widen, debt piles up, or central banks appear trapped into printing money, yields start to rise long before a crisis becomes visible to the public. This is why bond markets matter more than elections. Elections change who speaks. Bond markets change what is possible. A newly elected government inherits the existing debt stock, existing interest rates, and existing investor expectations. These are not reset by victory speeches. If anything, markets often react immediately to new governments, repricing risk within hours. In that sense, sovereignty is conditional. A country is only as sovereign as the bond market allows it to be. History is full of moments where this reality became impossible to ignore. In the 1990s, U.S. President Bill Clinton reportedly said that he used to think he was the most powerful man in the world until he realized that bond markets could intimidate everybody. That was not hyperbole. In 1994, rising U.S. bond yields forced the Federal Reserve to hike rates aggressively, triggering losses across global markets and reshaping fiscal policy. The message was clear: deficits had limits, even for the world's largest economy. The same dynamic appears repeatedly across countries and decades. Governments announce ambitious spending plans, markets react, and suddenly the plans are revised, delayed, or abandoned. This is often framed as responsible policymaking after new information emerges. In reality, it is submission to borrowing costs. When interest expenses rise faster than revenues, budgets implode. Politicians may argue about priorities, but the math leaves little room for ideology. What makes this power invisible is that bond markets do not rule directly. They do not pass laws or deploy police. They rule through constraints. Rising yields quietly eat budgets. Interest payments crowd out public services. According to IMF data, by the early 2020s, interest expenses were already among the fastest growing line items in many advanced economies' budgets. In the United States, net interest costs are projected to exceed defense spending within the next decade under current assumptions. No vote is held on this outcome. It happens automatically. This is why bond markets can be thought of as the real legislature behind the scenes. They decide how much fiscal space exists, how long deficits can run, and when austerity becomes unavoidable. Politicians argue over how to allocate money within that space, but they do not control the size of the space itself. That is set by investor confidence. The illusion persists because during calm periods, borrowing feels effortless. When yields are low, governments can issue trillions in debt with little immediate pain. This creates the impression that money is abundant and constraints are artificial. Central banks reinforce this belief by intervening, buying bonds, and suppressing yields. But this does not eliminate the bond market's power. It delays it. The constraint does not disappear. It accumulates. Once debt reaches a certain scale, small changes in interest rates have outsized effects. A government with debt equal to 100% of GDP that pays 1% interest faces a manageable burden. At 4%, the burden quadruples. At that point, policy choices narrow dramatically. Taxes must rise, spending must fall, or money must be printed. Each option has political and economic consequences, and bond markets price those consequences in advance. This leads to a deeply uncomfortable conclusion. Democracy operates within boundaries set by capital markets. Voters can choose representatives, but they cannot vote away arithmetic. They cannot decree low yields. They cannot command investors to accept losses indefinitely. When politicians promise everything to everyone without acknowledging these limits, they are not exercising power. They are performing. That performance is convincing as long as markets cooperate. When they stop, reality asserts itself quickly. The bond market does not need to crash governments overnight. It only needs to raise borrowing costs enough to force trade-offs. Those trade-offs are where the true hierarchy of power is revealed. Social programs are cut before debt service. Infrastructure is delayed before coupons are missed. Everything is negotiable except the bondholders. Understanding this changes how political events should be interpreted. Elections matter, but not in the way most people think. They influence tone, priorities, and distribution. They do not override the fundamental discipline imposed by lenders. In that sense, the bond market is not anti-democratic. It is indifferent. It enforces a logic that exists regardless of who wins. This is the foundation for everything that follows. Before discussing bond vigilantes, fiscal crises, or central bank interventions, one truth must be clear: governments do not rule economies unilaterally. They borrow. And whoever controls the price of that borrowing controls the real limits of government power. Bond vigilantes are not a formal group, a cartel, or a conspiracy. They do not meet in rooms or issue manifestos. The term describes behavior, not an organization. It refers to investors who collectively punish governments for what they see as irresponsible fiscal or monetary policy by selling their bonds. That selling pushes prices down, yields up, and borrowing costs higher. No announcement is made. No warning is required. The discipline is immediate and mechanical. The phrase bond vigilantes entered popular use in the early 1980s, when U.S. Treasury yields surged despite political promises to control deficits. Investors were effectively saying that they did not believe inflation would be contained, and they demanded higher compensation for holding government debt. This was not ideology. It was self-protection. If inflation erodes the real value of repayments, lenders insist on higher yields or they exit. This is the first thing to understand about bond vigilantes. They do not need to be right in the long run to be powerful in the short run. Governments finance themselves continuously. Bonds mature, roll over, and must be refinanced. Even a temporary loss of confidence can force a government into painful adjustments. The power of vigilantes comes from timing. States move slowly. Markets move instantly. The mechanism is simple but devastating. When investors sell bonds, prices fall. Because bond coupons are fixed, a lower price implies a higher yield. Higher yields mean new debt is issued at higher interest rates. Existing floating rate debt becomes more expensive. Debt servicing costs rise across the budget. At a certain point, interest expenses grow faster than tax revenues. Once that happens, fiscal policy stops being a choice and becomes an emergency. The United Kingdom provided one of the clearest modern examples in 2022. The newly installed government announced a mini budget featuring large, unfunded tax cuts, justified by optimistic growth assumptions. Within days, gilt yields exploded. The 30-year UK bond yield jumped from around 3.5% to over 5% in a matter of weeks, an extraordinary move for a developed sovereign. The pound collapsed. Pension funds using liability-driven investment strategies faced margin calls and were forced to sell more bonds, accelerating the crisis. The government reversed its policy within days. The prime minister resigned within weeks. No election intervened. The bond market decided faster than voters ever could. Italy offers a longer-running case study. With debt consistently above 130% of GDP, Italy's fate has often hinged on the spread between its bonds and German bunds. When that spread widens, it signals market doubt about Italy's fiscal sustainability or political stability. In 2011, as yields on Italian bonds surged above 7%, the government fell and technocratic leadership replaced elected officials. The policy agenda shifted overnight toward austerity and structural reform, not because voters demanded it, but because bond markets did. Emerging markets experienced this discipline even more harshly. Argentina is a textbook example. Repeated episodes of deficit spending financed by borrowing and money creation led to chronic inflation and serial defaults. Each time, bond investors demanded higher yields. When yield became unpayable, Argentina defaulted. This cycle has repeated multiple times over decades. The vigilantes never forgot. They simply adjusted the price of trust until lending stopped altogether. What unites these cases is not ideology or geography, but arithmetic. Bond vigilantes do not care whether spending is on social programs, military expansion, or tax relief. They care about the trajectory of debt relative to growth and the credibility of repayment. When governments insist that this time is different without convincing evidence, markets assume it is not. Critically, vigilantes do not need to attack outright. Often, the mere threat is enough. Policymakers are acutely aware of yield levels that would trigger crisis dynamics. This creates a form of preemptive compliance. Budgets are designed not around social need or economic optimization, but around what markets are likely to tolerate. In this sense, vigilantes govern indirectly, shaping policy before a single bond is sold. Central banks complicate this picture, but do not eliminate it. Quantitative easing can suppress yields by having central banks buy government bonds in massive quantities. This temporarily neutralizes vigilantes by replacing private investors with a price-insensitive buyer. But this power has limits. If QE undermines currency confidence or fuels inflation, bond investors shift their focus from default risk to inflation risk. Yields rise anyway, or the currency falls, importing inflation and forcing policy reversal. The U.S. Federal Reserve learned this lesson in the 1970s. Despite financial repression and accommodative policy, inflation surged into double digits. Bond investors demanded higher yields. The result was the Volcker shock. Interest rates were pushed above 15%, triggering a recession but restoring bond market confidence. This was not a political choice in the usual sense. It was a response to market discipline that had become unavoidable. Bond vigilantes are often portrayed as villains, sabotaging democratic choices. In reality, they are the enforcement arm of budget constraints that exist whether acknowledged or not. When they act, they reveal problems that have been accumulating quietly for years. Deficits that seem manageable under low rates become lethal under high rates. Promises made under one interest rate, regime collapse under another. The most unsettling aspect of vigilante power is that it is asymmetric. Governments can try to reassure markets with speeches and forecasts, but credibility is earned over years and lost in days. A single policy misstep can undo a decade of restraint. Once trust breaks, regaining it requires painful sacrifice. Spending cuts, tax hikes, privatization, and external oversight often follow. By the time voters are consulted again, the key decisions have already been made. This is why bond vigilantes matter more than protest movements or parliamentary opposition. They do not need public support. They do not need moral authority. They only need liquidity and alternatives. Capital is mobile. It can leave. Governments, by contrast, are trapped within their borders and their balance sheets. Understanding bond vigilantes clarifies a central truth of modern finance. Markets do not overthrow governments by force. They do it by repricing reality. When yields rise, the fantasy of unlimited political choice collapses. What remains is the narrow corridor of options that borrowing costs allow. That corridor is where real power operates. By the time bond vigilantes act, the underlying verdict has already been forming. Markets do not wake up one morning and randomly decide that a country is finished. They respond to a structural reality. The bond market is where the long-term fate of nations is priced. Not in speeches, not in election platforms, but in yields, curves, and spreads. The reason is straightforward. Government bonds sit at the center of the entire financial system. They are not just funding instruments. They are benchmarks. Mortgage rates, corporate borrowing costs, bank balance sheets, pension liabilities, and insurance models are all built on top of sovereign yields. When the bond market moves, it transmits stress everywhere. This is why bond yields, not stock prices, are the ultimate macro signal. Start with the budget. Interest expense is the one-line item governments cannot renegotiate without catastrophe. Miss a coupon payment, and you trigger default, legal action, and exclusion from capital markets. Everything else is flexible. Infrastructure can be delayed. Social programs can be trimmed. Defense procurement can be postponed. Debt service cannot. As yields rise, interest expense grows automatically, consuming a larger share of revenue without a single new law being passed. The United States illustrates this dynamic clearly. Federal debt has exceeded 120% of GDP, and the average maturity of that debt means higher rates feed through with a lag. But the effect is inevitable. When yields reset higher, interest costs explode. According to Congressional Budget Office projections, net interest outlays are set to become one of the largest federal expenditures, surpassing defense and rivaling Medicare within the next decade under current policy. That outcome is not voted on. It is implied by bond math. This creates a hierarchy of spending enforced by markets. Bondholders are paid first. Everything else competes for what remains. Politicians may frame cuts as ideological choices, but the ordering is dictated by creditors. This is why countries under bond market pressure always slash discretionary spending before touching debt service. The real constituency that must be satisfied is not voters, but lenders. Beyond budgets, bond yields shape monetary policy. Central banks are often portrayed as independent masters of interest rates. In reality, they operate within constraints imposed by bond markets. If a central bank sets policy rates far below inflation for too long, long-term bond yields rise as investors demand compensation. The yield curve steepens, financial conditions tighten anyway, and currency depreciation accelerates. The market overrules the signal. This tension is most visible in countries that attempt to cap yields. Japan is the extreme case. For years, the Bank of Japan has enforced yield curve control, buying massive quantities of government bonds to keep long-term yields near zero. This policy works only because Japan has deep domestic savings, a captive investor base, and persistent deflationary pressures. Even then, the cost has been a collapsing yen and a central bank balance sheet larger than the economy itself. The moment inflation returned globally, pressure on the system intensified. Yield control did not eliminate bond market forces. It displaced them into the currency. For countries without monetary sovereignty, the bond market is even more decisive. Members of the Eurozone issue debt in a currency they do not control. They cannot print euros at will. As a result, bond markets treat them like emerging markets. During the European sovereign debt crisis, spreads on Greek, Portuguese, and Spanish bonds blew out because investors realized these governments could run out of money. The European Central Bank's eventual whatever it takes pledge was effective precisely because it addressed bond market fears. It was not a political statement. It was a guarantee aimed at yields. This brings us to debt dynamics, the quiet equation behind national decline. When a country's average interest rate on debt exceeds its economic growth rate, debt ratios rise even with primary budget balance. This is not theory. It is arithmetic. In such a regime, stabilizing debt requires either sustained austerity, financial repression, or inflation. None of these are politically popular. Bond markets understand this and price accordingly. Historically, nations that fall into adverse debt dynamics face a narrowing set of futures. Some choose austerity, accepting years of stagnation to regain credibility. Others choose inflation, eroding debt in real terms while destroying purchasing power. Some default outright. The bond market does not dictate which path is taken, but it makes clear that all painless paths are illusions. Crucially, central banks cannot rescue governments indefinitely without consequences. Quantitative easing can suppress yields, but it expands the monetary base. If real resources do not grow alongside money, inflation emerges. When that happens, bond investors shift from worrying about default to worrying about purchasing power. Yields rise, currencies weaken, and central banks are forced to choose between defending the bond market or defending the currency. History shows they rarely get to do both. The fate of nations often turns on this trade-off. Britain in the 1970s chose inflation and currency devaluation, culminating in an IMF bailout. Latin American countries in the 1980s experienced lost decades after debt crises triggered by rising global rates. More recently, emerging markets facing dollar-denominated debt have seen their fortunes swing violently based on U.S. Treasury yields they do not control. In each case, the bond market was a transmission mechanism. What makes the bond market so decisive is that it aggregates judgment. Millions of investors, institutions, and algorithms continuously assess risk, growth, inflation, and political credibility. Their collective output is a yield. That yield contains more information about a country's future than any policy document. When it rises sharply, it is not an opinion. It is a warning. This is why bond markets decide the fate of nations long before collapse is visible. By the time unemployment spikes or services fail, yields have usually been signaling trouble for years. Political systems respond slowly. Bond markets respond instantly. One operates on election cycles. The other operates on survival. Once this is understood, the structure of power becomes clear. Governments propose. Voters dispose. But bond markets dispose of governments' options first. They set the outer boundary of what is financially possible. Inside that boundary, politics plays out. Outside it, reality intervenes. This is not cynicism. It is the operating system of modern states. Any country that ignores its bond market eventually learns the lesson the same way, through crisis, reversal, and loss of autonomy. The bond market does not overthrow nations. It reveals which ones have already overreached. By the time events reach the political stage, most of the story has already been written. Elections, speeches, emergency summits, and televised debates create the impression that history is being shaped in real time. In reality, these are performances inside a script drafted elsewhere. The bond market does not care who is speaking. It cares whether the numbers add up. Politicians deliver the lines. Bonds decide whether the show can continue. This is why political drama so often follows market stress, not the other way around. Governments announce bold agendas. Markets react. Yields move. Currency weakens. Then suddenly, the agenda is reconsidered. Policies are paused. Ministers are reshuffled. The narrative becomes one of prudence and responsibility. What changed was not ideology. It was borrowing costs. In this sense, politicians are actors constrained by a financial script. They can choose tone, timing, and emphasis, but they cannot change the ending if the bond market has already decided it. A government that loses access to cheap financing loses freedom of action. It may remain formally sovereign, but functionally it becomes reactive, managing crises rather than pursuing vision. Every major political promise eventually collapses into a single operational question: who will buy the bonds and at what yield? Welfare states depend on it. Military power depends on it. Energy transitions depend on it. Even maintaining basic services depends on it. When demand for bonds weakens, everything else becomes negotiable. The bond market exercises veto power without ever casting a vote. This dynamic explains why governments that appear strong suddenly behave as if they are weak. It explains abrupt policy reversals that make no sense to the public. It explains why leaders speak about markets with a mix of resentment and fear. They understand, even if they rarely admit it, that legitimacy comes from voters, but solvency comes from creditors. The most revealing moments occur during crises, when the mask drops. In those moments, democratic language gives way to technical language. Decisions are justified not in terms of justice or growth, but in terms of stability, confidence, and market reaction. These are not abstract concepts. They are code words for bond yields. When leaders say a policy is not credible, they mean investors will not fund it. This leads to a hard truth that most political systems avoid stating openly. Fiscal democracy is conditional. Citizens can choose how resources are distributed only after the bond market has decided how many resources exist. When debt is low and yields are stable, that space feels wide. When debt is high and yields rise, the space shrinks brutally. Democracy does not disappear, but becomes constrained, operating under emergency rules set by creditors. Historically, this is how autonomy is lost without invasion. Countries do not wake up one morning conquered. They wake up unable to refinance. From that moment on, external conditions shape internal decisions. Bailouts come with strings. Reforms are dictated. Sovereignty erodes quietly, one yield spike at a time. The process looks technocratic, but its consequences are deeply political. The uncomfortable implication is that many political debates are theater. Arguments rage over policies that will never be implemented because they violate bond market constraints. Campaigns promise futures that arithmetic forbids. Voters are encouraged to believe that the right leader can override structural limits. When that proves false, disappointment is directed at individuals rather than systems. This is not because politicians are uniquely dishonest. It is because admitting the truth would expose how little room for maneuver actually exists. It is easier to pretend that power lies in offices and institutions than to admit that it flows through markets that no one, elected and no one fully controls. The bond market, however, is not a conscious ruler. It does not plan outcomes. It reflects incentives and constraints embedded in the system. In that sense, it is not a shadow government but a mirror. It shows societies the cost of their choices in real time. When those costs rise faster than societies are willing to pay, the reflection becomes unbearable. The danger ahead is not that bond markets suddenly become cruel. It is that they remain consistent while political promises grow more unrealistic. Aging populations, rising entitlement costs, climate spending, and geopolitical competition all require massive financing. At the same time, debt levels are already extreme. This combination leaves little margin for error. When confidence breaks, it will not be gradual. Bond markets reprice regimes, not policies. The final illusion to discard is the belief that collapse begins with chaos. More often, it begins with spreadsheets, with auctions that clear at higher yields, with central banks forced into impossible trade-offs, with budgets rewritten not by parliaments, but by debt service projections. By the time streets fill with protests, the real decisions are already locked in. This is why the bond market is the real government of the modern world. It does not rule through law or force, but through constraint. It sets the outer limits of ambition and punishes those who pretend those limits do not exist. Politicians may change. Parties may rise and fall. But as long as states borrow, power will ultimately rest with those who decide the price of that borrowing.